Hey, everybody. Welcome to today's presentation. Altos is very proud to bring back our quarterly update with Logan Mohtashami, lead analyst at HousingWire. We're going to get started here in just a second with Logan taking the stage, but a couple of housekeeping items here. Let us know where you're coming in from. We love to understand where our audience is at. What's going on in your market. So you can use the team or the chat function on the right side of your screen. Drop in where you are, if you're having a good year, if the market is hot, if it's slow, what's going on with inventory. A great part about these presentations is that it brings top performing real estate professionals in from across the country. So drop in what's going on in your market so that everyone knows where you're coming from. Before we get started here, do want to plug something very quickly. So we have a couple really interesting announcements that we're rolling out here at Altos. So anyone who is not on the platform yet actually has a really unique opportunity to start a 14-day trial within the platform. So this is in our pro tier, and that allows you access to 10 zip code reports, customized branding. You can enter contacts, you can set up automated emails to your clients, a really good way to stay front and center with your sphere of influence, help them understand what exactly is going on in their market, just like Logan is going to share at a national perspective what's going on in the USA. So definitely go over, click the link that's being highlighted right now, go to this page. And if you haven't set up an account yet, give a 14-day trial a shot. We do also here have the option for you to get a free market report, no credit card, no questions asked. That's something you can continue to reference, but it's only one market. And I know everyone here works in more than one market. So if you already have a free account or you're in our light plan, which is 5 zip code reports, you can upgrade within the platform. Just click the yellow upgrade button in the top right corner once you're inside your Altos account. Click upgrade, you have access to this 14-day trial. The other really interesting thing is that we upgraded and changed our advanced plan, which now gives you access to every report in your state. So 10 reports isn't enough. You're looking to break into a new market. The advanced tier is a great option for you to take a look at. Again, you can do that here on the pricing page. You can get started immediately, or when you're in your account, if you're an existing user, even on the free account, so you can jump in, get started on advanced, get every report in your state. So again, questions, anything that comes up during the presentation, use that chat function. If we have time, Logan's going to answer live the wildest questions that you guys can dream up. But I know everyone is very hungry for him to take the stage. So I'm going to go ahead and introduce Logan Mohtashami, lead analyst at HousingWire, who's joining us for the Altos quarterly market update to tell us exactly what's going on. So Logan, welcome. Thank you so much for joining us.
It is wonderful to be here. Very fortuitous timing. This is past July 4th. The housing market has surprised a lot of people. I think for those of you that read the tracker, follow our podcast, what's happened in the last 12 months is not a surprise. But my job here today is to give you kind of a halftime report of where we're at and what we can think about going out in the future, because a lot of people have been somewhat surprised considering all the drama that's happened in 2026. But let's start with it right now. The number one thing that I always like to talk about with my first chart is the housing market, to me, revolves around the 10-year yield. And this chart I use at a lot of my events. This is what I call the slow dance. This is the 10-year yield and 30-year mortgage rate, right? And I don't necessarily forecast mortgage rates. I really forecast where I think the 10-year yield can go. And because of that, majority of this is really Fed policy. And I think one of the things that has surprised people this year is that we went into 2026 with assuming that we were going to get 2 to 3 rate cuts. Kevin Warsh was going to be there. Trump wanted rate cuts and everything. And the labor data improved. And I think that's the number one thing. A lot of people think it's the conflict, the war itself, but because the labor data has improved, all rate cuts are off the table. Inflation is running hotter than what some people would like to see. And then obviously the conflict happened, but oil prices have come down. Regardless of that, mortgage rates have still stayed in the range that I thought they would this year. And the difference is 2026 is the first year since 2022, mortgage rates have not gone above 7%. Why? Fed policy is still not as restrictive as it was before. and the mortgage spreads get improved. We're going to go into that next, but this gives you an idea of why I think this is very important, because I religiously follow the 10-year yield, and what drives housing demand is lower yields and lower spreads. Next chart. Now, this is the Fed funds rate. One of the things I tell people all the time, and for those of you that are realtors or loan officers, the history of mortgage rates getting below 5.75 with the Fed funds rate trying to get to 3% is not with us. We don't have a lot of history. So if you're running into people that say, well, I'm going to wait until 5, people tell me on the internet we're going on a recession and all the rates are going to go down, they are incorrect. We don't really have a lot of history of rates going below 5.75. This is why I don't forecast it with the Fed funds rate, even if we get 2 to 3 more rate cuts, and that's it for the cycle. So kind of always think about mortgage rates getting down towards 6% the last few years is usually because the economy is showing some weakness. It's not because Fed policy has been restrictive or getting easy. Because of this, you need to explain to your clients that this is as good as it gets when you get near 6%. Now, if the Federal Reserve gets more dovish, if we go into the recession, now just remember in the last 16 years, if it wasn't for COVID, we would not have even had a recession in 2020. We would have been a 16-year long expansion. So that can't be part of the equation. The equation is that what realistically can rates go down to? 5.75, I can't go below that with Fed policy going to neutral. That is 2 to 3 more rate cuts still priced in. So kind of think of that going out, not for the second half of this year, but all the way out in the future. Until policy changes, rates near 6% is as good as it gets. Next chart. And the mother of all benefits in 2026 is mortgage spreads. Now, this is the history of mortgage spreads. This is really important. This chart right here is the reason why home sales are positive this year. Mortgage spread is the difference between the 10-year yield and 30-year mortgage rate. We always talk about the slow dance. Historically speaking, in the last few decades, 160 to 180 is normal. In 2023, we got above 3%. It's actually really rare to be above 3%. That was a very bad year on spreads. The last time that happened was in 1986. There was a lot of credit drama back then. We had the Silicon Valley banking crisis. The Fed was raising rates. But because mortgage spreads have come down to almost normal, volatility has compressed. And for everyone in the real estate and mortgage business, they know when volatility compresses, it's a better atmosphere to work. This has been the number one reason why home sales have pretty much been stable. If you take the holidays and snowstorm out of it, we really haven't had any weakness in about 12 months. We haven't had a lot of growth, but we haven't had a lot of weakness. And that's because it's the lowest mortgage rate curve, since 2022. If mortgage spreads did not improve, if we were at 2023 levels, they'd be near 8%. If they're at 2024 and 2025, we'd be over 7% most of the year. The reason I say this is we do not have a lot of data that shows housing data performing better with rates above 7. But this is the first year that volatility is compresses. This looks very normal to me, but not a lot of people know mortgage spreads. But this is how mortgage spreads have worked for decades. And as you can see, we've made a big improvement since 2023. It is a benefit for everyone listening today and for years to come, because spreads should not get worse unless some crazy thing happens. Not necessarily a recession, a credit risk, or the Fed really getting aggressive and hiking rates. So benefits for everyone for the rest of this half and also into 2027. Next chart. And this is a bit kind of a closer look to mortgage spreads. This is the year-over-year data. As you can see, we've made a very, very big improvement, especially from 2024 levels. This has allowed you to work in a mortgage rate environment between 6 to 6.75%. Without this, rates would be above 7. The whole housing dynamic structures changes to a degree. So this right here will be with us for the rest of this year. And it's the main reason why it's very difficult for mortgage rates to get above 7%. For those of you that listen to our podcast, I kind of went into that, why it's hard for rates to go above 7. So the worst is kind of over for us. Even if the Fed is getting more hawkish, the spreads really change the entire dynamics around the housing market for both real estate and mortgage. Next chart. Now, inventory. This has been a surprise for a lot of people, unless all of you have been following the podcast or reading the tracker. About a year ago, I said the housing market is shifting mid-June. And if you guys look at what happened here, 2025 year-over-year growth was running at 33% at one point. That was with higher rates. Higher rates, less demand, days on markets grow, inventory can grow, right? That's the thing. But because the mortgage spreads were getting better and the labor market was getting softer, the 10-year yield was going to go to a level to where it is very difficult for inventory to grow in a meaningful fashion. So now when we look at from mid-June all the way up to here, the inventory growth has not only just slowed down, in some of the weeks it's gone negative year over year, which was not on anyone's bingo cards, but kind of think of housing like this. 70 to 80% of home sellers or buyers, there's 20 to 30% inventory left. When mortgage demand grows, when first-time home buyers come in or investors, they don't necessarily give you a house, they buy something, right? So because of that, inventory growth has slowed since June of last year, all the way up into the point to where it's been negative most of the weeks recently. Now, this doesn't mean like inventory is about to drop in a very meaningful way, but it shows you the supply and demand equilibrium is balanced. It is a really a fair fight now between sellers and buyers. And as long as rates stay in the sixes, demand can be good enough to where it helps both markets, right? You don't want a terribly unhealthy seller market to where they can control everything when buyers don't have it. Or if a buyer's market is too big, sellers might not want to list or get ready to buy. But right now, it is as healthy as you can get in the housing market after 2022, right? The housing market during COVID was very unhealthy, savagely unhealthy. We had too many people chasing too few homes. Our own data lines, and just remember, with our data, it's different than the NAR and everyone else's. We track single-family homes that do not have a contract. These are available for sale. So it's a little bit different for us than other people. We only had 240,000 homes available for sale in March. Now we are at a level to where it's a fair game for everyone. But as demand picks up, it's harder for inventory to grow. This is the post-2010 qualified mortgage world that I run my models off when. I can explain this in a longer fashion. But for here, the Altos data basically shows you it's a fair fight right now. Sellers and buyers both are in it. This is a great backdrop for real estate agents, right? Because rates aren't elevated above 7%, hug of mortgage spreads. So that hopefully can explain why inventory growth, which a lot of people thought might have accelerated higher, even a state like Florida that has issues, unconventional in other housing markets, inventory is down year over year, very negative. But like a place like Washington, right, where inventory has been positive on a year-over-year basis, but the pending sales data is softer. That's a softer marketplace. You're going to have multiple varied data line sets to work off the tracker and on here, but the inventory story is just basically rates got lower, demand picked up a little bit, inventory growth was really good last year. It can't be sustained. It's just keep it as simple as that. And going out for the rest of the year, we should basically really have the same thing, unless mortgage rates get above 7% for a longer period of time, or mortgage rates get below 6% and demand really starts to pick up where inventory starts to go lower. For now, this is as close to as the healthiest market after 2022 you will have in housing. Next chart. Now, this is kind of our bread and butter. This is the new listings data. If I could teach every doomer in America that this is the thing they really need to focus on, these are the homes that come onto the market that don't have a contract. Normal new listings from 2013 to 2019 is basically 80 to 100,000. The last 5 years have been the lowest new listings data in history. The last 2 years, we have been able to get above 80,000. Right? Most home sellers are buyers. It's a positive. We want new listings back to 80 to 100,000 during the seasonal peak months. But we don't see stress in the market. We've never seen stress in the market at all in the last 5 years. If there is stress in the market where you get a surge of sellers, you will see it here. And because we don't have that, you don't have to worry about inventory escalating out of control or a lot of foreclosures coming to the market. If that was to ever occur, we will see it in our new listings data. Just to give everyone an example, during the housing bubble crash years, and I always write this in the tracker every weekend so everyone could realize, our new listings data was running at 250 to 400,000 per week for years. I can take the highest new listings print that we had in June of 2022, which was 91,000. I could double that. It wouldn't even get to the lowest levels during the seasonal slow period of new listings back then. Why? Forced credit sellers are not buyers, right? They are foreclosures, short sales, distressed sellers, right? New listings data was there because we had so many foreclosures. We had so many short sales back then compared to what a normal market is, that the new listings data was elevated for years and they weren't selling their house to buy another one. So healthier market now, even though we're not kind of back to normal. We have been able to get above 80,000 last year and this year. We're in the seasonal decline of the new listings data, but in any market you're working in, you go look at this data line, you compare it to the years that things were normal. If anything was really breaking, you will see it here. You need to adjust your business models based off of that. But for right now, a healthy new listings year compared to what we had, especially in 2023, where new listings data was at the lowest levels ever recorded in history. Next chart. Now, this is our total pending home sales data. Our total pending home sales is different than the weekly pending sales that I put into the tracker. This gives you kind of a moving average. And we've had a clear deviation on our sales data, like a lot of other real estate companies that report their stuff. This is very simple. We are working from the lowest levels of home sales ever, really, when you adjust it to the population. It doesn't take much to move the needle. Mortgage rates stayed below 6.64%, head towards 6%. That's always been the key in the last 3 years. Whenever rates get below 6.64 and head towards 6, housing demand has picked up. However, this year, rates started out, slightly under, but they shot up. However, they shot up to the point to where it never really broke above 6.75%. And this can explain, especially in the last few months, when we had the conflict happen and rates shot up, rates never got above 7%. But the next thing is the very key. The last 2 years, home price growth has slowed down. Wages have outstripped home prices, right? Because of that, housing has gotten a little bit more affordable. This is something we're going to talk about in tomorrow's podcast. Because housing has got a little bit more affordable on that front, you can basically handle a little bit higher rates better. We kind of saw that in the early part of 2025 when rates were between 6.75 and 7.25. But here, it's just lower rates, more wage growth, less home price growth, affordability got a little bit better, and demand picked up. And just remember, we are working from such a low bar. We have over 162 million people working. We have 5 generations of home buyers. It shouldn't be a surprise that with the lowest rate curve to start a year, demand's just a little bit higher. I thought we could get 237,000 more existing home sales this year. If rates just stay 6.25 and under, I don't believe we could get under 5.75%. If I did, I'd have a much higher home sales forecast. Even with rates going up a little bit higher, there's still a possibility for that to be hit. But housing held up just because affordability got a little bit better. And kind of remember this, we have near 5 million total home sales in 2023, 2024, 2025, 2026. The peak in the last decade when housing was very affordable, 3.25 to 5% mortgage rates, home prices crashed, with the peak in the last decade was around 6 million. So we're missing 1 million kind of mortgage buyers from the peak of last year with this affordability hit. So just kind of think about that, the 10-year yield, mortgage spreads. As long as prices stay cool, Mother Time works itself out. So this is just our version of our weekly total pending sales. This is more of a kind of a weekly average. Next chart. Now, this is our weekly pending home sales. This is a week-to-week data line. It can be very volatile, especially around holidays. Whenever you have a holiday, the whole country is not working, especially July the 4th, Christmas and New Year's. I refuse to even write the tracker anymore because, we have such low activity and people try to make too much out of it. The weekly data has been mostly positive outside the snowstorm. Oddly enough, in this crazy year, the snowstorm was the biggest impact on the demand data outside of Christmas and New Year's. This data line looks out 30 to 60 days, right? So 30 to 60 days, it'll hit the existing home sales market. We use purchase application data where the 10-year yield works. This is one of the reasons why last year I said the housing market is shifting. It's going to take 6 to 9 months for everyone to realize it. Very simple. Lower rates, better affordability, demand picked up a little bit. Take the snowstorm out of it, we would add a little bit more home sales. But you can track this for every single area in your own zip code. My job is just to talk about the national economics of it. Because mortgage spreads are much better now, it's kept the demand curve mostly positive. Now we're going to go into the seasonal decline in this data line, but this does not mean existing home sales can't grow. In fact, our biggest existing home sales prints in the last 15 years have all come in the winter. That's usually if mortgage rates go lower. So now all of you know, mortgage rates go down back near to 6% and demand picks up. That's very, very normal to all the data that we have seen in the last few years. So just think of that going out. The bond market, the Federal Reserve, all that stuff, come listen to the podcast, come follow me on Instagram, come listen or read the tracker. I will keep an eye on that. But now you have a framework now, because we've tested this in late 2022 when we started the tracker. We tested this in mid 2024, and we've tested this in mid 2025. We have 12 months of data that we said this model will give us growth. It has, and the weekly data tracks this for you in your own city, zip code, or state that you want. Next chart.
I think that's the end.
Oh, no, that's the end. So one final thing about everything on this. The housing 2026 is just kind of a better affordability story. It's not booming demand or anything in that. But what's occurring this year is the same benefit that occurred last year. Home price growth is positive. It's a little bit stronger than I had forecasted, but it's not going higher than home price growth. This means the setup for 2027 and the second half of 2026 is better than what we have seen in the past out there. And that's the thing that we always have to think about. That's why following the weekend tracker and the podcast and everything gives you an idea. But now all of you with Altos, you can do it in your own area. And hopefully that explains why inventory went negative year over year last week. It isn't because demand is booming. It's just the supply and demand equilibrium changed a little bit.
Yeah, and to answer a couple of the questions that came up during the presentation, and I do have a few for you, Logan, to tackle. Are these charts based on home sales with mortgages? Does it include cash buyers? Yes, it absolutely does. When we go to the actual market information, that is the Altos data that's within the platform. So that is any home for sale across the country, anything that is available for purchase. So again, the caveat on that is once it goes under contract, it goes pending, it falls off of the report. So we're able to track a little bit differently than maybe your local MLS or other data sources might be able to provide that information. But Logan, a couple of really good questions came up in the chat while you were presenting. One came directly as a DM. What would cause the interest rates to go above 7%? I think that there are a number of factors, but if we think about the doom and gloom, right? Like that's above 7 and we're hitting a big slowdown. What would have to happen for that to happen?
So oddly enough, I wrote an article about this yesterday. In today's podcast, HousingWire Daily, I go into it with a little bit more detail, but I'm just going to give you this. For rates to go above 7%, you need three things. Number one, the economy has to stay firm. The job data has to stay firm. Wage growth has to stay firm. Retail sales. We cannot have any slowdown in the economy right now. Number two, the Fed has to stay hawkish. What happened in the last Fed meeting is for the first time, it was basically an even split between hawks and doves. Now, that was also the height of the Iranian conflict. And one of the reasons why the 10-year yield is not really going above 460, we have priced in a lot of hawkishness right now. So for mortgage rates to go above 7%, you're not going to get the spreads to get really bad. You need the economic data to stay firm, and you need the Fed to stay hawkish. This is why the July Fed meeting is going to be really key, because a lot of Fed members were being hawkish because of the conflict, but oil prices are no longer at 110. They're at 72, 73 right now. So as long as the Fed just says, hey, listen, we're not going to go on another big rate hike cycle, it's really hard to get rates above 7% again when mortgage spreads are this low, right? It was easier in the last 3 years. If this was 23, 24, and 25, we're already past 7%. But mortgage spreads being down here and staying low is actually very normal behavior. You don't need the Fed or anybody buying mortgage-backed securities. This is just how spreads have worked for many decades. So better economic data stays firm, Fed stays hawkish, and as long as the conflict still's around, those are things that could get maybe mortgage rates above 7. But you need those things, and even with all that, it's really hard to get even above 7.25 with where policy and spreads are right now.
Yeah, an interesting comment in the chat that maybe buyers, sellers are just accepting of the fact that we're not going to be in the basement, 4s and 3s anymore. And the new reality is that, to your point, historically above 6.64, we're in a pretty, or below 6.64 rather, we're still in a pretty good spot, and the market's continuing to move in the right direction.
I mean, just for all realtors and loan officers listening, just remember, you can explain it this way. The history of housing, U.S. economics, if the Fed funds rate is going to be neutral at 3%, we don't have a lot of history of mortgage rates going below 5.75, like ever. It's very rare. For that to even happen, whenever rates get down towards 6%, it's usually because the labor data is getting weaker, right? The bond market is trying to get ahead of the Fed. So as long as the economy stays firm, right? Even with 2 or 3 rate cuts, it's just hard to get below there. You need normal spreads. You need some of those things to get us down there. This is why we don't go below that, because history is not on our side. And I think that's the best way to explain to people out there that you're really waiting for a recession at this point. And if it wasn't for COVID, we'd have 16 years of an expansion right now.
It was an interesting proposition, right? A job loss recession in exchange for lower rates. I'd probably take where we're at right now with a healthy housing market and a lot of people having their jobs, right?
Yes. I mean, that's why the history of housing markets, if you actually look at the existing home sales going back to 1968, whenever there's a recession, sales don't go much lower. They typically bottom out, and then sales grow for years because you get that another leg lower in rates. And then all of a sudden, Fed policy is different right now. So, of course, if I can't forecast that, that's why I'm not going below 5.75%. But I understand the hesitancy of some people saying, well, rates are, they listen to people on YouTube and all that stuff. That's just not how economics has worked. There's policy that drives this stuff.
So one other question came up. Do you have a sense of how the different luxury, first-time buyer entry home markets are performing in the grand scheme of things? Is one outperforming the other? For example, luxury performing extremely well, and the first-time home buyers are struggling at this point?
Where money is at, for example, let's go San Francisco. San Francisco was left for dead, and all of a sudden AI money came in, and it's the most unhealthiest housing market because you're getting so much. And it's just basically a few places in San Francisco. You're at massive overbidding. That is kind of like an AI money thing. Where housing is more affordable, when mortgage rates go lower, you tend to get a little bit more first-time home buyers. The reason that is the case, right? Like, for example, today's existing home sales and last month's existing home sales was the highest first-time home buyer percentage in a while now, actually. A lot of that is a low denominator effect. When you're working from a low base, the year-over-year growth could seem, but that's just because first-time home buyers finance more than 93% of their mortgages. Of course, in California, like 18% of home sales are inheritance, so you have to take that out of the equation. But in general terms, when rates go lower, first-time home buyers pick up a little bit more because they finance everything. But in areas where the affordability is better, it's easier for them, but you need a younger population as well. Like seven areas of the U.S. is more than 50% of the population. That's also where a lot of young people are at. There's also where affordability is hit, like in Los Angeles and Washington, places like that. So just kind of remember, when rates go lower, affordability gets better, you tend to have a little bit more first-time home buyers just because they finance most of their homes. They rarely pay cash for their stuff.
That's great. Well, Logan, really appreciate you sharing your insights with us. Logan is a frequent guest and the star of the show on the HousingWire Daily Podcast. So that's available on any place that you get your podcast. Logan, you're on 3 days a week, Monday, Wednesday, Friday, if I'm not mistaken.
4 days a week, and eventually I'll be on 5 days and twice a day. Sarah Wheeler will lose her thing. I'll be on all the time. But yeah, 4 days a week. And my job is to just explain everything that's happening on the day. Just to give everyone an idea of what's happening so everyone's in the loop. The weekend tracker is here with all those different variables out there. So anybody that's been reading that, it's not a surprise what housing is doing this year. Again, everyone needs one good nerdy friend. Let the chart daddy be your nerdy friend, and let's do this day in and day out together.
That's awesome, Logan. Well, before everyone goes, there was a really interesting comment in the chat, which is all markets are local, and that's really what we are specializing in here at Altos. So again, if you missed it at the beginning, we are offering the opportunity to get into the platform on a 14-day trial, 10 zip codes that you can monitor on a weekly basis, automated emails to your clients, customized brandings. If you have ever been in the platform on a free account, you can still access this. It's within your platform, which we're going to jump into right now. And I want to leave you with just a couple ideas on how to use the platform. So if you're at the top end of our scale, which is advanced, you get every report in your state. You can go into analytics, which is available only in this plan, and you can actually work with our team or recreate the charts that Logan was presenting today yourselves. Now, you can do local down to a zip code level here. I have price decreases in Dallas, Texas, pending data in Dallas, Texas, as well as the national information that Logan was presenting a little bit ago. This is great. This is a great research hub. Not all of your clients are going to want this level of insight, but what you can provide them within the platform are automated market updates that hit their inbox on a weekly basis. So within our platform, you can access any of your available reports. You can pull up a market report, which is a really great in-depth tool that you can use to give an at-a-glance view of exactly what's happening in the market. And of course, the curse of presenting, we are moving a little bit slow. So within this report, you have a really awesome tool called the Market Action Index. So if you are not Logan, but you want to see at a glance what the numbers are saying about a market, we make it really simple. You can understand if it's a buyer's market or a seller's market. So very quickly, we're taking all the data points within our system. We're applying our intelligence on top of it, and we're helping you understand very quickly what's going on in a market. So great if you get a phone call from someone, hey, looking at buying and selling in this specific zip code, as long as you have the space in your Altos account. Again, recommend that you get the advanced tier so you can do any report in the state, likely matching your licensing. You can pop in, really quickly understand days on market, inventory, median list price, year-over-year trends. You can dig deep and say, hey, in the past 3 years, here's exactly what's happened. So this is available to you within the platform and also available to be emailed to your clients on an automated basis within the platform using our contacts and campaigns. Now, if you only want to share out that market action index, let's say that you want to have a great asset to share on social media, you can go in and specifically pull out just the market action index. You can add your branding. You can actually add the market narrative. So let's say you want to go a little bit deeper. Let's say you want to send an email or send a text message to someone, give them that extra love and say, hey, here's exactly what's happening in your market. Boom, you have this information right here that you can copy and paste into whatever system you would like. You can also pull up market snapshots, which is another great tool that you can use on a localized basis. Again, this is Dallas, Texas, but we go all the way down to a localized zip code level. You can do houses, condos, co-ops, not appropriate in Dallas, but are available in some markets. Add or remove your branding. So really the platform is designed to allow you to have access to very frequently updated data. You have the ability to share that information with your customers and drive conversations and demonstrate yourself as the market expert. So just like Logan was on today talking about his market expertise, you can be in your market sharing all these insights. You can have it running on an automated basis so that you never have to really touch it, but you do get signals back about who's opening, who's interacting the report, so you know who to call and get a little bit smarter about how you're deploying your time. So really appreciate everybody joining today. Again, you can get into the Altos platform for free on one report. You can start a 14-day trial. You can upgrade yourself. You can reach out to our team. We'll help you build your data center, your advanced analytics dashboard so that you have a hub to visit on a weekly basis and understand exactly what's going on in the market. And also, we'll plug, listen to Logan's podcast, read the weekly tracker article on HousingWire. It's something that will do wonders in helping you to explain the broader dynamics of the economy, like mortgage rates, while Altos is taking the expert stance on what's happening exactly with home sales. Thank you so much for joining us today, and we look forward to hosting you or having you at the next presentation.